All right, welcome everyone. Again, let's officially get started. And I'd like to welcome you to today's webinar, which is titled Three Strategies to Protect and Grow Your Retirement Nest Egg. I'm very happy you guys have taken the time to be here today. My promise to you today is this. In this session, I will do the very best I can to let you know that you can retire with the peace of mind knowing that you can steadily grow your portfolio, that you can generate a safe, steady income, and that you can preserve your capital by understanding the strategic defense initiatives I'm going to talk about in this presentation. So hopefully you guys are ready to do that. If you are, um, do me a favor. Try to turn off any distractions like, texting while you're driving. We don't want to do that. Hopefully no one's driving is listening. Turn off all distractions. Try and stay focused. I think we've got some good information here for you, and so we're going to do our best to relay all that to you. Now, my name is Jim Penna. If I could introduce myself, I do see some familiar names in the chat room, but many that I don't that I are not familiar. So I'm the manager of retirement services here at VectorVest. I've been at VectorVest for about 14 years, just over 14 years now, and it's been a great run. As I mentioned, I'm from Connecticut. I worked on a trading desk for a large market making firm for a few years before I decided to move my family down in North Carolina area and found VectorVest. Seems like such a long time ago, and then sometimes it seems like yesterday. But I began the business way back in 1992, took my Series 7, began working on smaller trading desks until I became a market maker on a larger desk. So it's kind of my history and how long I've been in the business, how long I've been at VectorVest. I'm, again, excited to be here with you today. Just one more point on my background. Maybe 3 lifetimes ago now, back up in Connecticut, Norwalk, I was a policeman there in my hometown for about just under 10 years. So if at any point during the session, if it sounds like I'm telling you what to do, then that's where that comes from, and so just be prepared for that. That's just a joke. All right. Now, let's get started here. We're talking about building and protecting and growing your retirement nest egg. And a long time ago, when I've been in retirement service, I don't know, it was 8, 9 years, whatever it's been. And I found a quote, from a fellow Connecticut Yankee. Mr. Mark Twain said once, "Don't just sit there and worry. Be proactive. Do something, anything about what's worrying you so you can gain information, focus, and control over the situation." And I thought it was just the perfect segue into what I want to talk about today in building and managing the portfolio, especially the latter portion of what we're going to talk about today. Okay, but we don't want to just sit there. He goes on to say, "I've suffered a great many catastrophes in my life. Most of them never happened. And they don't have to happen if we're prepared and we're proactive." So a long time ago, through a conversation with Dr. DeLito, I was telling him about, when we used to go on the road for our seminars and all, and through emails and phone calls and all kinds of things, I relayed to him that the question I get in some form or fashion, not always exactly like this, but in some form or fashion, the question comes along from our subscribers, our students, our clients: how do I keep from running out of money in retirement? Is the question that I get. And so I was talking with Dr. DeLito, Dr. Bart DeLito, our mentor, our founder of VectorVest. And in the way that only Dr. D can, he said to me, "James, just tell him to just keep making more money." And so we began in the retirement services department, and through our courses and lectures and all our things, we began working towards doing just that. Now, here at VectorVest, we believe that a secure retirement is one in which you have enough income to live the life you desire. Okay, that's an important point. The life you desire. It may not be the cliche of buying a yacht and sailing around the world, although, you can tell these folks were VectorVest. They even named their boat the VectorVest. You see, they put the name on the side there. Okay, but we believe it's one in which you have enough income to live the life you desire. That might be sitting on the front porch, reading a book with your favorite adult beverage, whatever it is. Okay, we believe a secure retirement is one where work is optional and your retirement is affordable. This happens to be my preferred retirement, playing on the golf course. So to get there, we talk about peace of mind. How do we create that peace of mind in retirement? We call them the 3 Ps. Start with profit. means growing your portfolio, just buying good quality stocks, rising in price in a rising market, and having a good system behind that. The next P is provide. We want to provide a safe, steady income as you approach, or certainly when you're in retirement. That's a very important concept, is that safe, steady income. And then, as I'll say at least a half a dozen times before I'm done today, the most important concept here is preservation of your net worth. Protecting, preserving your net worth is important, and in fact, most important. So when we start with profit, I understand that no stock or no one's portfolio goes up on a straight line like this, right? But what we don't want are those violent drawdowns and the roller coaster ride that so many portfolios go on. And so we want to go from having a roller coaster ride to that steady climb when it comes to capital appreciation and growing your portfolio. Then we move over to provide. We don't want you having just a couple of dividend stocks that may have some trickling down theory, kind of idea of a few pennies coming into the portfolio. We want you to have a plan behind a dividend growth portfolio where you can have that steady flow of income coming in. And then finally, on the preservation side, again, which I'll talk about later, it's pretty simple. Instead of being unprepared and not knowing what to do or what to look for to be prepared for a market downturn, we want you to go from being unprepared to being prepared. Okay, so those are really the core strategies that I'm going to talk about today. I want to take just 30 seconds out so that I can get a sense of why you guys are here today and ask, what's the hardest part about preparing for retirement or being retired if you're already in retirement for you? What's been the hardest part about planning or being prepared for that? Just write a couple of words, take a minute, because I want you to stay with me. I'm going to interact throughout the presentation. So go ahead and type in. Okay, yeah, and here they come. Yeah, Mark says starting late. Yeah, Mark, I'll talk a little bit about that. It's a good comment. Starting too late. We like to say it's never too late to get started, right? To employ at least some of the aspects that we're talking about, depending where you are in your retirement planning. But that's one we've heard a lot. Fear of losing capital, Ron said, and that is a very legitimate fear. I'll talk about preservation of capital. There's as we go through, I'll emphasize a lot of my opinion on that. Mark has a good one. Mark says, knowing how much money you need to retire. Yeah, Mark, there's a lot of ways to calculate that out there. We're not going to really talk too much about financial planning per se here, but that's a great question. But it always leads back to Dr. D's comment about just keep making more. David says confidence in trading. That's a huge one, I think. You have to believe in a process or a plan and what you're doing. And I'm going to offer that to you today. Stu says market volatility. We're going to talk about how to deal with that. And there's a lot more coming in. I can't comment on every one, but Gary, I'm gonna use yours, and then I'm gonna segue into our presentation. But Gary says, with over 8,000 stocks available in VectorVest, choosing the right stock is a challenge. And Gary, it can be if you don't know your objective. That's a great point. It can be. But if you know your objective and you know what your goal is to accomplish, it becomes a whole lot easier. But I'm glad you you wrote that. Bill, all right, welcome, Bill. Bill was out raking leaves, so that's no problem. I'm glad you're here. I hope everything is going well, and I hope you're staying healthy, Bill. Okay, boy, so a lot came in. I'm gonna, from what I'm seeing in the chat box, I'm feeling as though you guys are in the right spot today. So let me jump into the three core strategies. And again, we'll continue to answer any and all questions, but I want to give my presentation, answer any questions. Again, John, my colleague, is in the background answering questions as well. But I want to go through the three core strategies, and I'm going to start with our circles here. So we know capital appreciation or profit, as we said, income, and capital preservation. Let's start with capital appreciation. Let's talk about that core strategy first. So under the profit umbrella, we talk about capital appreciation comes from owning companies with consistent and predictable financial performance. Okay, consistent and predictable financial performance. And I always ask, what two better adjectives to describe the type of stocks that reside in your retirement portfolio than consistent and predictable? And that goes to Gary's comment, finding the right stocks. So we're going to talk about that. Dr. Bartolito has said and written many times, good portfolio management starts with buying the right stocks. That's where it begins. And so I use my baseball analogy, which I'll use throughout. Played a little ball back in college 100 years ago, and I always thought of Dr. D's comment there about building a team, right? And you can insert your favorite team here if you'd like. But I'm a big Mets fan, and when you build the right team and you put the right players on the field, when you've got guys like Tom Seaver and Nolan Ryan was here somewhere, Jerry Kuzman, that was Cleon Jones there. So you've got. I'm sorry for anybody who might be in the Chicago or Oakland, and actually Oakland was Baltimore area, right? Oakland was the '73 World Series. So I hate to show this because people get mad at me sometimes. But just think of it that way. Think about building a roster of stocks that perform well and put a winning team on the field. That's the idea behind this slide here, is building that roster of stocks. And so when we do that, what we look at is building a portfolio based on safety first, especially for our retirement account. When we're talking about a growth portfolio, we want to look at a company's safety more so than anything else. Someone would type, Bill says, go Cardinals. Yep, we love the Cardinals too. Okay, well, it's fun to hit the home run, most of the time, to continue the baseball analogy. What happens to our home run hitters when they don't hit a home run? Okay, especially in this day and age in the ball game today, the way it's played, what happens to them when they don't hit a home run? And someone can type it in. Well, there we go. Mark says, I know everyone's thinking it. Just takes time to get through the type in there. But yeah, they strike out. Right? Dennis says it too. Yeah, strike out. Which is fine in baseball, but not when it comes to developing and building and managing our retirement portfolio. So it's unacceptable. So what we want to do is focus on safety first. So we have some factors that go into our stock safety checklist that we use, that Dr. DeLito used in a formula to be able to analyze a stock's safety. Excuse me. So here's the stock safety checklist. So when we say a stock in the VectorVest program is safe, we're talking about, and I'm just going to touch on these briefly, earnings consistency, right? Simply put, does a company make money quarter over quarter, year over year? Right. We know that every 90 days, the most important part of it, every stockholder looks for that date when earnings is coming out, and they know what can happen to their underlying asset if those earnings are either favorable or unfavorable. So a company's ability to make money quarter over year is what we're talking about here. Company size, Dr. D put into the formula because it's important to understand that, the size of the company is important, but just because a company is large does not necessarily mean it's safe. Okay, so while that is taken into account, think the one stock I usually use. I know they're trying to make a comeback, but GE is one of the names that comes to mind. A large company, but for a long time not a very safe company. So company size plays a part. Price behavior plays a part. A stock's smooth, steady, northeasterly direction on a graph is what we want to see. But part of the formula, this part of the formula that Dr. D puts into the analysis says, okay, what if a stock is well above its mean or well below its mean? There's a lot of mathematics that go into it, but it is part of what relative safety is. Business longevity. How long has a company been in business? We understand that a newer company doesn't mean it can't be a good company and have some great growth. But for this, from a safety standpoint, better the devil you know than the devil you don't. And so that plays a part. Dividend history. Understand that a company doesn't have to pay a dividend, doesn't have to pay a dividend to be a safe company. But if it does, well, darn well better continue to pay and grow that dividend over time, because, as Dr. D wrote, there is no greater black eye for a company than to either have to cut or reduce or suspend its dividend. It's a very poor reflection on the company's earnings, insights, and on the board itself. So very important factor there. And then finally, debt to equity ratio. A favorable balance sheet, right? In case a company runs into headwinds, whether it's specific to the company or the overall economy, that they're not in such deep debt that their interest payments and their taxes cannot outdo their earnings, right? Anytime a company pays more in taxes and interest than they earn is a very bad indication when considering the stock's safety or lack of safety. So those are the important checks on the checklist that we talk about. You can go try to learn that data, or look that up on your own. From experience, again, from being at VectorVest for a long time, and even prior to that, I know a lot of people get frustrated trying to figure that data out on their own. So what we've done here at VectorVest is created one single indicator that looks at all of that information. And it's called relative safety, is the proprietary indicator that Dr. D created. It's an indicator of risk, and again, it's the consistency and predictability of financial performance. Okay, that's how we assess relative safety. And among our other indicators, it's on a 0 to 2 scale. And you can see the breakdown here. Ultimately, anything above 1.1 up to 2 is anywhere from good to excellent. And that's what we're looking for. In fact, I lean much closer to the excellent, very good to excellent, when we're talking about relative safety. Okay, so I thought it's important. I always think it's important to talk get a little deeper into relative safety, so that you understand when we talk about, okay, yeah, RS is at 1.4. Well, what does that mean? That's why I spend the time to explain exactly what goes into relative safety. Now I can show you what it looks like in our Unisearch tool. So this is just a screenshot from my VectorVest program back just last week, not even a week ago, on Veterans Day. I took this screenshot. And it's from a search called Ruler Stocks. Now the Ruler Stocks search focuses on stocks, or just to make the list, I should say, the relative safety has to be at least 1.4 or greater just to make the list. The other important factor is the earnings growth rate. That's in percent per year. Has to be greater than or equal to 14%. And then we actually sort the stocks by relative safety times earnings growth rate. That brings the best combination of those things, that the company with that, to the top of the list. On this date, it happened to be Netflix. So you can see the relative safety column here with some well-known companies that I'm sure you're familiar with, virtually all of these companies. And with a relative safety of that number, what I like to say is that what usually happens, and I'm not going to go too deep into some of our other proprietary indicators right now, but when we have a relative safety number that looks like that, what usually happens is the other numbers that I care about when we're talking about building a retirement portfolio fall into place right here. So relative value is the price appreciation potential of the stock. On a 0 to 2 scale, you'll see some very strong numbers. Now, not every stock has it, and I'm saying it's not every stock does the number fall into place, but more than likely they will. Okay. The other numbers I care about are, one is comfort index. Comfort index is what we define as the price growth persistence. In other words, a company's ability to withstand lengthy or severe downturns. Doesn't mean the company can't go down in a downtrending market. It's just more resilient, and that graph pattern is much more smooth to the upside. Earnings growth rate, as you can see here, is phenomenal. And they don't all pay a dividend, but when they do, the growth is good and the dividend safety is very high. Now, dividend safety is the one indicator it's on a 0 to 99 scale, not 0 to 2. But you can see that the power of relative safety uh, comes into play when it comes to analyzing stocks. Okay, ruler stocks is just one example. Let me go back here before I go to that. So the last stock on the list, this is the last out of 20. It's number 20 out of the top 20. Now, it's funny because it is the highest ranked relative safety stock. Its RV is pretty good. Its comfort index is fantastic. And its earnings growth rate is, you know, at 19% per year. And it happens to be the lowest growth rate. That's the lowest growth rate. But it is a great stock that I actually personally own in one of my accounts. And so I'm going to use it as an example. It is a relative safety as of less than a week ago was 1.48 on West Pharmaceuticals. This is a 5-year look back, and I use it just to illustrate, to show you what I just went through in the previous slides. So we've got that lower left to upper right price movement. And remember, these are pretty, on this log here on the side, these are pretty big increments. Okay, price increments. So while it might not look like a huge move, over the 5 years, that's a pretty big move in the stock. And you can see down below is the VectorVest representation of earnings per share over that same time frame. And you can see the growth and the movement of earnings per share. It's a combination of historical and forward-looking forecasts. And you can see how that earnings per share has grown. Okay, and it's not coincidental that those two are moving in the same direction. I've added dividends to this graph. Again, this is still just a 5-year look. Remember, a high RS stock does not have to pay dividends, but if it does, it better continue to grow them. And West Pharmaceuticals has for at least 25 years or more. West Pharmaceuticals has grown their dividends, so I just wanted to add that in to what is a great company. I get a question a lot of times because I talk a lot about what we call ruler stocks, and a lot of folks will ask why are they called ruler stocks. And very quickly, the idea comes from the concept of being able to put a ruler on those graph patterns. And like I said, we know nothing goes straight up. I understand that. But the idea of ruler stocks comes from, the earnings or the price is that it has that straight line momentum moving to the top. So we like to call them ruler stocks based on that. So that's the importance of relative safety when it comes to building a portfolio based on the objective of growth or capital appreciation. Relative safety plays a very large part in that. And so when we focus on a portfolio of high relative safety stocks, again, there are other examples in other searches, but I use ruler stocks very simply because in the 14 years I've been here, it's my favorite. It performs the best over many of them, but there's a lot of ways to find other good quality safe stocks. But this particular portfolio, again, as of less than a week ago, was up, I'm going to call it 116%. Okay. If you annualize that out over just slightly under 4 years now, right, this was a model portfolio. We use it in our Tuesday retirement coaching group. It was beginning of the year in 2017. So I'm going to call it 4 years, 28.2% annualized rate of return. 28.2% annualized rate of return. And we've seen a lot of fluctuations in the market. We've had a down year in 2018. We had both January and October of 2018, as you can see here, and then of course the February sell-off. Now, if there's anyone who happens to be in the room that doesn't think in a retirement in any portfolio, at 28.2% is really good, then you should give me a call because we need to talk. Now, the question always comes in, we want to compare it to the bellwether. I just read a long article about, money managers, fund managers, and mutual funds and all just trying to compete with the S&P 500 and using that as their bar. And even in the most conservative portfolio that I can build in VectorVest, we can outdo the S&P 500. And in fact, this one has, as you can see, up till, again, just a few trading days ago, The S&P 500 is up, I'll call it 58%, 15% annualized rate of return. We've doubled that. We're able to double that with a very prudent uh, risk management investment plan behind it. Okay. So I'll ask you to type in, as my voice is getting a little scratchy, I want to take a quick sip of water. Just type in. What would you rather have? What shift? Wouldn't you rather take the shift from no safety to finding these type of stocks to fill your portfolio? So either type in no safety or safety as I take a quick sip of water. Okay, great. Excuse me. Great. Yeah, and listen, I know the answer. Thank you, guys. I want to keep you guys working with me here, and everyone's typing in safety, of course. Mark says I do love the home run once in a while. Trust me, Mark. With these type of stocks, you do get one out of the park now and then. They're not they're not stocks that are going to move sideways on you. But um, Kenneth says much of the safety comes from market timing. A lot of it does, Kenneth. Getting in at the right time has a lot to do with it. Having a reasonable, logical risk management plan behind it certainly plays a part in it. There's no doubt. Okay, well, that's the focus on safety when it comes to building a growth portfolio for your retirement. What I want to do now is switch over to income, the second core strategy that I want to focus on. And I want to make clear that I am shifting gears here a little bit, right? We've talked about capital appreciation. Always, always, before you hit an enter button for any trade that you do, I don't care if you're a day trader, and by day trader, I mean trading for nickels and dimes on a 2 minute bar chart, or swing trader, retirement trader. Before you hit the enter button, you have to know what your objective is. Why am I hitting the enter? Why? And I don't want to hear it because I want to make money. I don't. That's unacceptable to me. Okay. So why am I hitting the enter button? And when it comes to income, I'm shifting gears here, and I'm going to talk about our objective, and that is to generate that safe, steady income. So let's move on to that. Okay. That's the second P, or provide. Steady income flow from we're going to talk about from both dividends and from covered calls. Now, part one, so we have two parts here. Part one is going to be about dividends, part two about covered calls. And let me just say real quickly, if you're in the room and you're not familiar with covered calls, if you've never sold a covered call, okay, don't go anywhere. Don't push back from your desk and say, "Oh no, they're going to talk about options." I don't want to do that. Please don't do that. If you are building and managing your own net worth, then I think covered calls and another option trade called protective puts are essential for you to be successful. Okay? That's what I believe, and that's what we're going to talk about. Covered calls are the most basic, the most popular option income trade there is. They're the easiest, the most, and because that's why they're most popular, because they're easy to do. Anyway, I'm going to talk more about it, but anytime I offer up an option trade, I want to be sure that you understand you don't need to be an options expert by any stretch of the imagination to understand a covered call or a protective put. And I'm going to explain it to you in great detail in the next few minutes. Anyway, let's start with dividends. So we're going to get paid. That's our objective. I want to get paid. Think of it as your ATM here when we talk about both dividends and covered calls. Now, if you Google good dividend stocks, this was a while ago, you may get even more results here. And what you'll find every time you Google good dividend stocks or whatever website you go to, they're going to automatically use the current dividend yield and bring those stocks to the top as if those were the best dividend stocks. Right? Just because it has the highest yield, our question remains, are they good, safe companies? Are they good stocks? And it's going to happen wherever you go. Right? These are just some examples of dividend stocks being sorted by the highest yield. I mean, here's a stock that, or whatever it is, trading at 92 cents, the 25% yield. I mean, I wouldn't even stop and look at that. That's not what we're looking to do. So, what we do, again, just like we do for our relative safety or those type of stocks, is we come into the VectorVest program, and I'm just going to use, there are many searches and many ways to find these in the program, but I have time to focus on one to explain how, or I should say, what we look for and the characteristics we look for in a good quality dividend growth stock. So I don't know, about 4 years ago or so, I built a search and did a special presentation called Blue Chip Dividend Payers. And I made it as basic as I possibly could, so it can always be tweaked to, certain objectives that others may have. But I wanted stocks only from the Dow Industrials, Transports, and Utilities, because these are always good yielding stocks, good, well-known, mature companies, or from the S&P 500. I wanted stocks that paid at least a 3% yield. And the stocks had to come from one of two watch lists in our program, DRIP 10 to 24 or 25 plus. What does that mean? It simply means that the stocks on these two watch lists within our program have not only paid but have grown their dividend for this amount of time. Right. So I want to be sure we have stocks that have a long history of growing their dividend. Okay. And then we had to make sure that the dividend safety was greater than 50. All right. The reason for that is we have to be sure that there's a favorable payout ratio. So when we're looking at companies that pay out a dividend, okay, when they pay a dividend that's greater than their earnings per share, that's a huge red flag, right? How long can a company sustain paying out a dividend? Now, there are some exceptions. There's some closed-end funds, there's some MLPs. I'm not going to go into all of that right now. I'm talking about well-known, good quality, mature companies that pay a dividend. Okay, so there are some nuances behind that, but what we're looking for are these type of companies that you see here. Okay, so some great names here, and this is what we're looking for. And just like I did with West Pharmaceuticals, here's another stock I happen to own for a long time, T. Rowe Price. Right, T. Rowe Price. This is by the way, you can go back this far in VectorVest. 25 years this goes back. And down below I have the dividend payout. Remember I talked about it on West Pharmaceutical, what I like to call the golden staircase. And you can see T. Rowe Price is what they call a dividend aristocrat, a member of the S&P 500 that has not only paid but grown their dividend 25 years or more. And I forget T. Rowe Price is even longer than that, I believe, but that's what you get when you look for these type of dividend paying stocks. Okay, that's what we want it to look like. Okay. Now, just as I did with the growth portfolio, when we look at a portfolio that focuses on quality dividend growth stocks, here's just an idea of what we've been able to produce. Now, this is a longer term because I want to look at the objective of generating a safe, steady income over a longer period of time. Now, this was again a portfolio we use in our Tuesday coaching group that began a few years back as a model, and then I just continued the portfolio. So this one actually began in January of 2013. So let's call it 8 years now. The percent gain on this, or it was began with $100,000, is 133.61%. Now that is, when you calculate it out, just about. And this is as of last Wednesday as well. Again, I'm going to call it a 17% annualized rate of return. Okay, that's pretty good. Annualized rate of return. Now, what that number does not take into account are the dividends that were collected, because our portfolio manager in VectorVest doesn't automatically calculate the dividends. Now, what I've done up until about 2 years ago, calculated every position, the life of every position, and calculated to the penny the amount of dividends that we would have collected. At that time, almost 2 years ago, it was about 33,000 and change. I stopped doing it, quite frankly, because it became too cumbersome, time consuming. Plus, I think I made my point. I have a spreadsheet that calculates it. So that's a low ball figure. So with $35,000 in dividend payouts, let's just say you didn't reinvest or take that money out. Right now, you've got 168% return on your investment. What does that mean? It means that without even reinvesting your dividends, you've got 21.25% annualized rate of return over an 8-year period, with what I like to call, in the most loving way, this is the most boring portfolio to manage. It's got a very prudent slash conservative management technique behind it. Excuse me. Sorry about that. Just a little scratchy throat. This is I got a very prudent conservative management technique, and what this doesn't include, even with this, is the compounding or the reinvestment, the power of reinvesting those dividends. So that number would be even higher if you did that. So again, to go out and compare it to the bellwether, the composite was up, or I'm sorry, the S&P 500 is up 100, we'll call it 144%, or 18.3% annualized rate of return. So even there, when you compare it to the S&P 500, and the reason I do that is because most hedge fund managers, most folks who manage wealth for a living, that's what they go by, and that's why many of them can barely beat the market. Okay, um, so that is the income side, part one. Let me get into part two, and I want to walk through this. I want to introduce you to covered calls. I'm sure a lot of folks in here have traded covered calls. In fact, to keep you going with me, just so I can get a sense, if you've ever put it here, answer this question: have you ever traded a covered call? Type in either yes or no. Dennis says nope. Okay, so they come in fast. I'm just trying to get just to eyeball a sense of. Okay, it's actually good. I'm getting more. I'm getting more no's than yeses. A good amount of yeses, but I think more no's, which is actually good. Kenneth, hopefully I can explain that to you, because again, it depends on your objective, Kenneth. Kenneth says, don't understand why one would sell covered calls versus getting out of the market or buying the contra ETF. Kenneth, maybe I can explain the objective behind a covered call, and maybe I can change your mind, or at least get you to see why we would do it. Okay, that's my goal. I like the challenge. Covered calls. So I actually like that a lot of folks haven't done it. I'm going to kind of take it from the bottom floor up. We believe at VectorVest, and I believe that if you're building and managing your retirement nest egg, that part of that is a safe, steady income. Okay, and that one of the best ways to do that is to understand how and have a process for selling covered call options. Okay, covered calls. So let me first give you this definition. It comes from a gentleman named Lee Lowell. He wrote a book called Get Rich with Options that caught Dr. D's eye, and so we all read it here at VectorVest. And Mr. Lowell was an options trader, market maker, worked in the option pits. And I use this quote because to me it was the most straightforward, the most logical reasoning behind why you should be selling covered calls. And I highlighted the definition here. There are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Selling covered calls is such a great strategy for padding your bank account. Still can't believe there are investors who aren't taking advantage of it. Frankly, neither can I. Okay. So let's get a quick description of a covered call. It's the simultaneous purchase of an underlying stock and the sale of a call of the same security. Now that's known as a buy right, where you buy the stock and you sell or write the contract. Same thing, they're synonymous, sell and write. Very quickly, what's a call option? If I buy a call option, it gives me the right to buy 100 shares of a stock at a certain price by a certain date. Right? I pay out money, I buy that right, and it costs me money. The value of a call option rises when the value of the underlying stock rises. Okay. Now, if I sell a call option, right, I get paid. So I have no rights, rather I have obligations. Right? So I get paid, but I don't get paid for nothing. Which means I have to provide the stock to the buyer at that certain price. Which is fine because I already own the stock, so I know where I stand. I know exactly how much I can make and exactly how much I can lose going into the trade. So that's the name covered call. I'm covered because I own the underlying stock. And of course, you can sell one option against every 100 shares of stock that you already own. Okay, so that's the definition. Let me illustrate it here. I think it'll make a lot more sense when I show it here. If you own or buy 100 shares of stock, let's just say you buy the stock and you sell the call at the same time. Again, this is just an illustration, right? A theoretical trade. Buy 100 shares of Dollar General at $112. Okay. You then sell a call with a strike price. That's the price you agree to let someone call away your stock from you. Okay. Which is the strike price. So I would go out and sell someone else the right to take away my stock at $115. And they would pay me $2.65 to do that per share, or $265 for one contract. I own it at 112. Somebody paid me $265 to take it away at 115. Okay, that's the setup. It's as basic as that. So let's look at kind of a what if scenario. If the stock goes down, the profits from the call that we sold help to minimize our losses because we lowered our cost basis, right? We bought it at 112 and I sold the call at 265. 112 minus 265, if my math is right, correct me if I'm wrong, somebody in the chat box, would come to 109.35 is now the cost basis of my stock position. If the stock falls below that number, I will begin to lose some money. Just like because I own the stock. So the risk isn't inherent in selling the call. Selling the call adds absolutely no risk. In fact, lowers your risk because it lowers the cost basis of the stock. So there's a cushion there. The stock could actually go sideways. And I could make profits, hold on to the stock, and continue to sell another covered call against it. Continue to lower my cost basis and continue to generate income. And then I can either that, or I could, if the stock goes up, right, they call it away and I end up keeping my max profit. So in this scenario, at expiration, Dollar General closes at 119. I would have made $300 in capital appreciation. That's the 112 plus the $3 up to 115. And I would have kept the 265 in premium. That's $565 gain. Okay, in about a month, about 30 days. Okay, so that's what a covered call would look like. Let me show you some actual trades and walk through a couple of trades, or a few trades that we did. Again, in our Tuesday coaching group, we have a process that we actually go out and walk through these trades. And this goes back to June of 19, and to this day, currently, as I speak, I have another AMD trade open and profitable near its max profit as I speak. So starting back on 619, we bought 300 shares of AMD and sold 3 covered calls against it. A month later, we closed AMD with a profit of $603. That's 6.81% return on investment in a month. Now imagine if you had a stock that paid 6.81% annual dividend, you would think that that's a great dividend payer, right? This was 31 days we made that. Let's I'll show it again on 8/6 of last year. Same thing. Closed the position at a profit of $600. That was another 7.4%. The system that we use in our coaching group had us in some other stocks, but got us back into AMD in November. Okay, made another 4% in just 28 days. December. This time it was only, what was it, 10 days. 5% return in just 10 days. Buying the stock, selling the covered call. And then I kept the slide in here. I actually created this slide for an earlier presentation back before the sell-off. This came to February, right before the pandemic sell-off. We had opened another 200 share position, and I left this because I thought it was kind of funny. At that point, I wasn't sure where the position was going to close, but we were up 375 bucks at the time. And then we closed it on 218 right before the sell-off for another $538. And then through 2020, after the sell-off, we continued 5 trades this year alone in AMD that were up. So it really is an important concept in generating income. Very easy to do, and an important tool to have in the toolkit. So that's income, dividends, and listen, it's something you can do. I know that you can do it, but you have dividends and covered calls to look at a way to generate income in your portfolio. Now, capital preservation. I'll take just a few minutes on this. I see some questions coming. If you hear me pause, I don't want to get distracted from the presentation. Stay with me. I will answer any and all questions. John, just green flag these. I'll answer them all when I'm done. I see a couple, but if I start answering them, I'm going to get off time here, and I don't want to do that. And anytime I see someone complain about the taxes that you make from a profit, okay, so would you rather have a losing trade, would be my question, Joe. Would you rather have a losing trade? Okay, you have to pay taxes. It means you made money on your trades, the cost of doing business. Right? If you do it in an IRA, you don't have to pay taxes until you get older. Okay. All right, let's talk about capital preservation. Again, in my opinion, the most important part of what I'm talking about here today, because as the great hedge fund manager, Mr. Ray Dalio, once said, he said, you cannot be profitable or make money in the market without taking some risk. And he went on to say that, and you cannot keep your money if you are not defensive. Okay. Step number one in building and growing your retirement portfolio is to protect and preserve your net worth. Okay, so how do we do that? How do we do that? Well, we put an insurance policy on our assets, right? It's called a protective put option. It's an insurance policy. That's all it is. And it comes back to the quote. If I'm worried about where the market, and I know somebody said you just sell your stock earlier. I saw it. It grabbed my attention and it makes my blood pressure go up. You can always just sell a stock. So don't anybody type in, why not just sell the stock? I understand that you can just sell a stock. I'm talking about building and managing your retirement portfolio. Now, if every time an earnings report comes out, if you want to rebalance your retirement holdings every 90 days because of an earnings report, go right ahead. I'm trying to show you don't have to. So don't just sit there and worry. Be proactive. That's what we're talking about when we talk about insurance. There are strategic times that you can identify where you need to be protecting your assets. So what is the core of what I'm going to talk about for the next 5 minutes or 10 minutes? Protect your assets. Okay. The idea, the objective is to reduce risk. We buy a put option to protect individual stock positions, or you can do it to protect your entire portfolio. What is the quick definition of a put option? Here's what a put option is. If I buy a put option, if I'm the buyer of a put, which is what we are going to be here, It gives me the right, if I buy one contract, to sell 100 shares of stock at a certain price by a certain date. Those are the terms and conditions of the contract. The value of a put option goes up, it increases when the value of the underlying stock falls. Right? That is the definition of an insurance policy. If I have an asset that's damaged, I get paid to help offset the damage. That's all we're doing is buying an insurance policy. You have car insurance, health insurance, homeowners insurance. Heck, my wife and I, we have insurance on our two dogs. I got pet insurance, for crying out loud. Right? So that's all we're doing here is buying a put option to insure our net worth. Let's look at an example. Texas Instruments. I'm sorry. Okay. Texas Instruments. I'm going to do actual case study here, but let's just say you really wanted to be defensive. You own Texas Instruments. And for the sake of our theoretical discussion here, you own it, you bought it on a confirmed up call, and it did exactly what you wanted it to do. Now, what could I do if I own a stock, it's up 20% roughly, okay? And again, I don't want to sell it. It wasn't a trade, okay? It wasn't a swing trade. It pays a dividend. I want to hold on to the stock. What could I do if I want to defend it because of a downtrending market or earnings report coming out? Well, I could buy a put option. Okay, depending on the strike price that I use depends on the amount of insurance premium I'm going to pay to own that stock. The higher strike price you buy, the more expensive it's going to be, but you get better protection. So if I own a stock, at this point it's at, well, I'm going to walk through the case study here. Let me walk through it. Okay, so here's our case study for Texas Instruments. All right, so again, we bought Texas Instruments here. Who knows? Maybe you bought it way down here at the earlier confirmed call. Right? And the stock has done just what we hoped and wanted it to, not hoped, but what we thought it would do. Good quality stock in a rising market. On this particular, again, don't worry about the dates and times. On this date, the stock's trading at 120 bucks. That's a 20% return, or $2,000. Okay? Now, 1 week prior to earnings, I want to protect those gains. Because here's the mindset I believe you have to have. You have to look at this as though, I know we paid roughly $100, give or take. That's the cost base. I understand that. But the mindset I want you to have is that I actually own the stock at 120 now. That's my money. It's my asset. That's where it's trading now. That's where I own it. And it's incumbent upon me to protect that profit. Okay? If I get, now listen, of course it can draw down a little bit, but if I allow myself to give back too much of that gain, it's my fault for not being proactive. And there's no reason to do it. So, in this case, in this scenario, I'm going to buy a put option. I'm going to buy the right to sell 100 shares of Texas Instruments at $120. If the stock goes up, the value of my option will rise, offsetting the damage to my asset. Okay. What happens? A week before earnings, I place that trade, I buy the option, and what happens? After earnings, the stock gaps down. I forget exactly why. I don't know if it was a missed report or some guidance or something specific in the report. I don't know. I don't remember. But the stock gapped down after earnings. So the put option I bought, and again, I just did one contract. You might own 500 shares. I don't know, if Texas, whatever it might be. I'm just doing 100 shares. The put increased in value, offsetting the loss of the stock. What cost me $423 the very day of earnings, the earnings were announced, it's now worth $1,128. Well, what does that mean? Had I not bought the insurance policy, I would have given back 50% of my profit. Right? Would have been gone. Had I bought insurance, as I showed, we profited about $700 on the put option, which gives us a position total now of $1,700. In other words, all I did was have a drawdown of $300 instead of 1,000. That's what's called mitigating your losses, mitigating drawdown. Okay, so you So you drastically minimize that loss. And that's just one position on one earnings report. You know, the idea is that over time this becomes a very powerful tool to do that. And Lloyd says, I'm not showing any expiration dates on any of your puts or calls. No, Lloyd, I'm not going into the actual setup of the trades. Roughly, we place them a week before earnings, and because it's based on a specific earnings report in that particular case, you would go out to the front month expiration. You wouldn't need to go out any further. So you're right. I'm not showing the actual setup because we'd have to have a 3-hour webcast to do that. But yeah, I understand your point, and when we're doing it this way, just go to the front month and buy the put there. The important part of what I want you guys to take away is that you have to be proactive. Okay, you have to be proactive. You don't have to type this in. I know we would rather mitigate drawdowns than not. Okay, I know that would be if I asked you to type in either do nothing or buy insurance, I know you type in buy insurance, or at least I hope so. How about this? Anybody who thinks they should just do nothing, type that in so we can have a chat. Okay, so, excuse me, I'm sorry. Buy insurance is what we want to be able to do. Mark says, please show how the premium for the put impacted the trade result. I did. I'll show it one more time very quickly. I bought a put at $423. My asset was damaged and it fell. The value of my put option rose to $1,128. My profit on the trade is $1,128 minus $423. I rounded it to $700. So that is the impact. Right? The value of the put's $1,128. I paid $400. Shows me with a profit of $700 on the put option. So hopefully that helps. Okay, great, good. Okay, so let's take one quick look here at the case study for the overall market. Let's look at the overall market here, and here's how you can protect yourself in the overall market. It's very similar, so I'm gonna click through it here. I was creating this slide for a presentation again as before the pandemic sell-off. And in my interaction and webcasts and classes and things that we do with a lot of our students and subscribers, I was starting to get the feeling that everybody at this point thought the market was never going to go down again. And so I was emphasizing the idea of being proactive, of protecting your net worth and not getting, too complacent. And so I told folks, don't talk to me about this move in the up market unless you can confirm to me that you remember this move and I know it seems like forever ago. This is October of 2018. In this day and age, 2 years is an eternity. I understand that. But the market went down a lot back here, and you could have been prepared and protected yourself. If you didn't, right, there was a 20% sell-off there. If you didn't, it took you a year to get back to even before that next rally. And I know it crept up above it, but it pulled back, and then the next real rally moved here. It would have taken you a year to get back to even. Okay. Okay. So that's an important concept. That's time use of money. You don't have to sit through that, wait a year just to get back to even. So I zoomed in on the late February pandemic sell-off here. And then I zoomed even tighter. Here's a scenario. Now this one is not a trade from our coaching group, although we actually use debit spreads on the SPY, but the SPY is the ETF that tracks the S&P 500. Here's an example of being proactive. We have two longer term signals, I guess you'd call them. The DEW timing system represented a down situation on February 24th. That would have been a good time to become defensive and buy SPY put options as an overall insurance policy for your portfolio. The next call, our line in the sand, if you will, our last call is the confirm call, which came on February 28th. Would have been a really good time to become defensive and buy put options. Okay. Two very distinct dates, two dates that you didn't have to do hours of analysis. Just look at the color guard and know that the DEW went down and so did the confirm call. Time to become defensive. So I just want to show real quick. This one again is a theoretical look at the power of being proactive. So this is puts for portfolio protection. I'll start with the DEW. The signal went down. It would have been a good time to place the option trade. You could have bought one put option on the SPY. The SPY was trading at 322 at that time. And at that time, you would have paid $9.75 per share, give or take a quarter of a point. Okay, that's $975 to protect, let's just say, a theoretical $100,000 port. You could have bought more, 3, 4, 5 option contracts. For our purposes, we bought one, just to make my to convey my concept here. Now, what happened? 3 weeks later, on March 13th, that April 322 put was trading at $71 per share. Okay, $71 per share. That would have been over $6,000 return, or 628%. Now, please understand this. I'm not saying that you would have held it exactly to this date. If I was going to do that, I would have put this date on there and it would have been worth even more. Understand that what I'm trying to convey is that insurance policy, if you had closed it anywhere around here, would have done a great job of mitigating the drawdown in your overall portfolio. Maybe not exactly dollar for dollar, but your damaged asset would have been offset by your insurance premium, to continue on with the insurance analogy. The value of a put option rises when the value of the underlying asset falls. Now that's the DEW, and then just to finish this off, puts, if I use the confirm down, okay, could have bought that same SPY put, but now the SPY just 4 days later was down to 296. Remember, it was at 322. If I bought one at the money put option, I would have paid $14 per share, and it still would have been a great, smart time to go defensive. And then I put the expiration date here. I just bought the front month at 320. Again, just as an example, the put was trading at $67 per share, and this is just to give you an idea of when the market craters like this, how helpful these insurance policies can be. And again, I'm not saying you would have held it right to there. Anywhere in this range here would have netted you a large return on your insurance policy. Okay, and I've seen a couple of comments come in, and I just want to comment real quick on those. First of all, here is that equity curve of ruler stocks. Okay, yes, it has drawdowns. Nothing goes straight up, but when you mitigate these losses, it works out really well. Elaine is a customer back in the January of 2018, when we had a big sell-off, and he had taken a course, our Ultimate Retirement Solution course, and he wrote what means a lot to me. He wrote me an email: Jim, because of your teaching, I hedged my portfolio, and with just $835, he was able to garner over $23,000. This was January of 18. It went from 285 all the way down, traded as low as 250 at some point. That's a huge, huge move. And Elaine was able to take advantage of that. Okay, so that's capital preservation. And to those who say, you know, what if I talked about cover, what if the stock goes up? A protective put on a stock during earnings. What if the stock goes up? That's great. That's better. I want that. I don't want the stock to go down simply because I bought a protected put. Right? It's an insurance policy, and if I don't need it, that's for the best. It's the cost of doing business. Okay, if I lose 300 or 400 or 500 bucks on a put option and my stock goes up, I close the trade and I say, great, understanding that you'll understand when you do it that you sleep much better the night before an earnings report comes out. Okay, and as far as the overall portfolio, it's the same thing. Not every DEW or confirmed down crashes like I just showed. There's not a pandemic sell off every time a confirmed down call comes. I understand that. And so you might lose some money as an insurance policy. But the answer I give is this. Every month, the 18th of every month, I look at my bank statement and Geico Insurance, who are great by the way, my car insurance. I ACH or automatically pay my monthly car insurance bill. When I go look at my bank statement and I see that I just paid them, I don't, you know, bang the table and say, darn, I didn't need that insurance. A tree didn't fall on my car this month, or something else terrible didn't happen to my vehicle. And now I'm mad because I had to pay him another month. It doesn't work that way, right? You don't feel that way. You're not mad, God forbid something happens to your house because you had to pay homeowners insurance. You have to look at it that way. You have to look at it that way to be able to mitigate the drawdown. Otherwise, your time, use, and money will be spent, and you're missing out. You're missing out when you don't protect and preserve your net worth. I know I'm going into. I told you, if it sounds like I'm telling you what to do, I'm going cop mode a little bit here, but I just believe it's important. I believe it's important. Okay. So let me review real quickly here. When we talked about growth portfolio, remember growing our portfolio, and that's why I wanted to talk about. Might we have given back a little bit here? Sure, but if we were proactive, we were able to mitigate that drawdown. Okay, so those drawdowns don't even have to hurt as much. And again, these were the same slides as before. We talked about that. A dividend growth portfolio. Again, when we follow the plan, we get dividends, and then again, even better when you reinvest those dividends. Okay, we can still, even in the most boring portfolio, still outperform the S&P 500 over time. Okay, and then I talked about income with covered calls. How simple it is once you learn the process. We showed our individual stock protective puts, and I talked about the power of protecting your overall portfolio. So I'm glad you guys took the time to be here, and I'm going to answer every question that came through when you guys stay with me. Hopefully you'll stay with me for just a few more minutes. You may ask yourself, how can I implement these three core strategies that Jim just went through? Right? How can I get results quickly? Well, I think it's time to make a choice. Right? We say it's time to make a choice. You can do it on your own. You could continue to try to build, manage. Manage is the important part. Protect your portfolio. That could take a while. You keep doing what you're already doing, you may continue to see the same results. Okay. Trial and error. All that gets you is making the same mistakes over and over again. So we want you to stay out of the maze. I'm sorry. Or you can do it faster and use a system that's been proven to work so you can bypass those years of trial and error and begin to grow your portfolio and protect it. And that's why we put together the Ultimate Retirement Solution online course called Protect and Grow Your Retirement Nest Egg. It's the Ultimate Retirement Solution. Right? Protect your nest egg. Okay. So I want to tell you about the course real quick that we offer so that you can employ these three core strategies. It takes me just a minute or two to walk through this. There's a whole lot more that goes in with the course than what I'm about to show you, so be patient, stick with me. And the first module, these are all the lessons that are taught. Win before you begin. Lay a clear path to victory. I've been doing this long enough to know that if you don't have written down somewhere your objectives, your vision statement, if you will, that you're going to have a lot harder time being successful in planning and building your retirement portfolio. So we'll walk through that. It's a very important module to get started. In modules 2 and 3, we walk through building the growth portfolio I talked about, as well as building the dividend growth portfolio. There are ways to identify the right stocks at the right time for each objective, and we'll walk through step by step the, the, the investment plan behind each one. Module 4, for those who haven't traded options, I will break it down step by step, explain to you exactly the what, when, and how of a covered call. It's not hard to do. If you understand buying a stock and selling a stock, you understand the concepts of a call option, a covered call option. Right? You just, and I'll show you in a moment some results that we have. Then in Module 5, we'll talk about being prepared and knowing what to do. You guys remember the strategic defense initiatives back in the 80s, right? President Reagan had the Star Wars. This is kind of our version of that. You have to identify the times when you need to be protective in your portfolio. Okay? Understand the value of it and why we do it. Okay? And then finally, in Module 6, we'll talk about we'll kind of round things out. We'll talk about implementing the actual trading plan, especially we have a very specific trading plan for the covered calls. We'll walk through that in Module 6. We have our trading checklists and other things. Now, again, these are the modules that you get in the VectorVest University when you sign up for the Ultimate Retirement Solution course. There's so much more that goes with it, though. So give me 2 minutes to explain everything that goes with these 6 modules. First, we have 6 live mastery support sessions. What's a mastery support session? Well, the module you go through on your own in the VectorVest University. And then what we do, and I have a schedule for it so you'll know exactly what days, it's starting next Monday. Every Monday at noon, we have a live session. And we go through implementing what we learned in the previous session, right in that module. So we have 6 of these. We look at what you're doing, we help guide you. And if you can't make the live session, don't worry, we have a dedicated email bin for you to submit questions there. And we record everything we do and we put it into the university. So that's available to you. Next is 6 weeks access to the retirement coaching group. I mentioned earlier, I talked about our retirement coaching group. It's a separate entity where we get together every Tuesday at 2 p.m. Eastern Time. And first thing we do is a weekly retirement update on all of our portfolios. Our dividend portfolio, our growth portfolio, and what we refer to as the income portfolio. That's this here, weekly covered call income trade. Okay. The AMD I showed you, what we walk through every week, that trade. Okay. And we do that, and all of those are archived and recorded and put into the university as well. For those some folks said yes to covered calls. Maybe you're familiar with credit spreads. You get a great bonus session after the course is over, trading credit spreads for monthly income, conducted by our friend and colleague, Mr. Ron Wheeler. Nobody does it better than Ron, teaching high probability trades using credit spreads. So you get a free bonus for that. If you're in the room and you are new to VectorVest, say if you don't have a subscription, we'll give you 60 days to get through the course. It's the best tool to determine market direction and find stocks. Okay. We put a quick value on all that. I'll just scroll through this quickly. Right. All of that on its own costs, it costs money to do all that stuff. If you order before the end of today's webinar, we will get you what's called the fast action bonus. Right, what we call the early bird pricing is $5.95. You can get all of what I just walked through, and I'm going to show you exactly what that entails in a minute, for just $4.95. Okay, just $4.95 by going to vectorvest.com/URS. Okay, and John just put that up in the chat box. You guys can simply click on vectorvest.com/URS that John just put up there in the chat box, and here's what will happen. It'll bring you to this page, and this is where, if you scroll down, it'll tell you all about the course that I just went over, Each module, all the things that are involved. There's a lot of resources involved. Okay, you can save. The original price is $9.95. If I hit purchase course now, it'll bring me to this page. Again, the buy now bonus will be up there for at least, I don't know, at least the next half hour, maybe a bit longer. Again, I'm going to answer questions as much as I can for those who are here still. Okay. Of course, we'll take you by the hand, guide you through the exact three-part management method you need. Now, when you get to this page, go ahead and click proceed to checkout. If you are new to VectorVest, fill in the basic information here and hit submit to join the course and get your 60 days trial. If you're already a member of VectorVest, if you currently have either a trial or a subscription, simply click sign in. It will ask you to sign in using your VectorVest information, and it will bring you to this page eventually where you can place your order and save some money. Okay. Now, here's the key part of all this. They say in the market always that there's no such thing as a risk-free trade. Well, after this course is over, if you show you've done the work and you're still not satisfied, we will gladly give you 100% of your money back. That's how confident we are that you will build a foundation that will last you a lifetime. Okay? It's a money back, it's a risk-free trade for you. One covered call will pay for all of the resources that you get. The question you have to ask yourself is, how much is it costing you not to do this? How much money will you lose? How much potential profit will you miss out on? How much time and energy will you spend trying to do this on your own? Then ask yourself how your life might be different if you do this and it actually works. Right? Somebody mentioned it about being too late earlier on. It's never too late, we say. There's an old saying, when's the best time to plant an oak tree? They say 20 years ago so that you can be enjoying the shade now. And they say that the next best time is today. So, for the low price of $4.95 for all of those resources I just showed, and here, just for anyone who's worried or asking or concerned about when the live sessions are, they start the 23rd and they are every Monday at noon Eastern Time. They will all be recorded and placed in the university. And then you kick the new year off right with Ron's bonus session on selling credit spreads and generating income. Okay. So one last thing I want to do is just open up the university and show you exactly what is involved in getting the course here. And so if I go to university.vectorvest.com, no www at the beginning, it will bring you, and this is for anybody who's a current member, it will bring you to this page. Go to your dashboard. Now in mine, I have access to all of our courses, so don't worry about all this. But when I come down to the Ultimate Retirement Solution and I hit that button, I just want to show you what all the resources that are in here. So we have a welcome video first, then module 1. This is the actual module that you'll have access to as soon as you join up. We give you a homework assignment in each session. And we actually do a video to show you how to walk through that. Then we post, like I said, every Monday at noon is the mastery session. We record it and post it later that afternoon so you can watch it live if you missed the live version. So you can see each module has its own setup here. Okay, we'll show you, there's a lot of resources within each module. Okay. And then you'll see, as I come down, you'll see the module for trading spreads, and then the retirement coaching group. You'll have access to 6 live sessions. If you can't make the live session, we'll put it there. You also have resources here where you get all of the slides and any PDFs that we have that go along with that. So there's a lot of information here in the university that we do live, all for just $4.95 and a money back guarantee on that. Okay. So for those who stuck around to get an idea how to learn more about what I talked about, thank you for doing that. if you did go to vectorvest.com URS and you signed up, please type in the chat box "I'm in," just to let me know. I can tell you what to expect once you do sign up. Just know that you will get you'll get an email from us with all of the instructions that will point you towards the university. And Dennis is in already from the summit. Great. Ken also says he's in. Fantastic. Thank you guys. I look forward to spending time with you live on Monday. Um, yeah, Ken and Dennis, Dennis, you may have gotten it already. Ken, you'll get an email uh, with the instructions on how to get into the course and exactly what to do. And if there's any issues, you let us know. Dwight's asking, what is the elite price? Um, the elite price, Dwight, um, is $497.50. Remember, the price is $995. This for any elite members. You can go and hit where it said. I think it showed if you're an elite subscriber on the order page. Um, but $495 if you do it now, you actually save $2.50. See, we're making you money already there, Dwight. Sue Ann saying, please put the slide on dividend stocks. We missed it. I'd be happy to. Excuse my scrolling through here. Let me do it this way. Okay. I'm not sure exactly which dividend slide. I'll try this one and see if this is the one you meant. And we'll show that. Sue Ann, tell me if that was the dividend slide you were referring to, and I can leave it up there for you. So again, for anyone who has gone into the website, let me know. If you're having any issues getting in, let me know now. I can help you with that as well. If you're still trying to figure out if you want to join or not, let me give you a little more incentive here. If I go to show you a spreadsheet that we use in our Tuesday session. And this is just, we use our spreadsheet as a journal here. These are all the buy right trades. This is once a week, as long as the market is favorable. You'll see we didn't do any during February, through the sell-off, obviously. And you'll see AMD shows up a lot on this search. Doing it once a week when the market is at least showing some up signal in the market because it is a bullish trade. We currently have 80% winning trades and about a 20% return on our investment for this year. This is just the covered calls. You'll see I currently have an AMD trade open. It's up about $700 as we speak. I'm looking to make 944, so it's still open. 1170 just a couple of weeks ago. A few weeks before that, another 1110. This is just AMD. I'm just because I showed it in the example. I'm just showing you. This is on top of last year's trades. All the ones I showed you on the slide, this is in addition to those. These are not the same trades as last year. One AMD trade pays for your course, or maybe a couple of them, as it turns out. So that's our progress. Those are real trades that I'm showing you, actual trades.
Hey Jim, can you hear me?
I can actually, John. I didn't know if you could get in or not. That's why I didn't ask you to hop in.
Yeah, I was having some problems with my mic for some reason. Is it clear,
Clear enough. Yeah,
Jim?
you're good. Yeah, you're good.
Okay. All right. Question here from Lynn, which is actually a typical question. Um, does the course apply to other countries' markets? In her case, specifically Canada?
Yes. Hi, Lynn. Yeah, that's a great question that we get all the time, and I will give you my honest answer. And the answer is yes. It is to both Canada and to all of our other countries that we have our database in. Here's the one comment though. When it comes to market trends and timing and understanding when to buy the stocks, how to find the right stocks, those concepts uh, relate to all over the globe. The difference is for covered calls and put options. Many times, the option markets in the other countries are a little less liquid. Doesn't mean you can't sell covered calls against well-known larger companies in Canada or Australia or UK. It just becomes a little more time consuming to find the best candidates. Okay. So having said that, that's the one thing I like to be clear about. It does relate, and you can do it, but sometimes it's a little more difficult to find the best candidates. So hopefully that helps, Lynn. Um, do you,
Sorry.
no, that's all right.
Yeah. Next question here is from Lewis, who's asking about for what you're teaching, what's a good amount of money to start with to have to continue to invest in trader?
Yeah, no, that's another great question, Louisa. We get a lot, and it's an easy one to answer and a hard one to answer. So, you and I see a couple of the numbers you put down, either 10 or 20,000. And my answer is yes. If you're beginning to, and it doesn't have to be just, I'm making hand quotation marks, a retirement account, right? If you're investing in the market and you want to grow and protect what you have, right? It's all relative. $20,000 is, or $1 million, it doesn't matter. It's your money, so it's everything. So, you can build a portfolio of ruler stocks with $20,000 or $10,000. You may be even more inclined to want to do the buy right trades because you're never really fully invested in the buy right trades, right? And that's what makes those even better, right? What we call the buy right or the weekly income trade, right? We never had more than $50,000 invested at any one time in that spreadsheet sample I showed you. We're up over 20% with 80% winning trades. Just because you can't buy 1,000 shares of Facebook in a portfolio doesn't mean you're not going to do it right. Right? It's all about percentage gains and growing your portfolio. So 10, 20,000, 50,000, you can do it with that for sure. And yeah,
Jim,
yes.
question here, which ties into actually a couple of other people. So they're getting access to VectorVest.
Hmm.
How long do they get access to that? And relatedly, how long do they get access to the recorded material, the
Yeah.
content?
Uh, yeah, that's a great question. So if you're new to VectorVest, we give you a free trial for the life of the course, which is roughly 60 days. You get 60 days access. You do have access to this course for one full. That's what I did forget to mention. That's a great question. One full year after the course ends, you have access to it. So it's not like you finish the course and you're off on your own. You have access to the course, access to the dedicated email bin for one full year once the course ends. Okay. Um, so that again, it's a long time to be able to go back and make sure you're doing things right. Suan, here's what I'm going to do, Suan. Suan, if you can send an email to that address, then I will. I'll chat with you and help you out there. And Suan, I don't know if you meant this dividend slide. I'm not sure which dividend slide that you meant. So hopefully that's the one. Okay. See there, Dennis says support at VectorVest is very helpful. That's right, Dennis. Throw that one out there, John, while you're looking for other questions.
I see here Philip is asking about the agenda going forward for the
Oh,
course,
yeah.
live
Okay.
sessions,
Yeah.
etc.
Excuse my scrolling through. I know that give people a headache. This is if that's what you meant, Philip, that is Those are the modules that are found in the university that if you sign up today, you'll have access to those, what, John, later tonight, right? Uh, Tomorrow at the absolute latest.
Yes.
Um, and then you can go in and watch all the modules, all the resource videos that go with it. So if that's what you meant by the what do they call them in college? What do they call the you get at the beginning of the year? Tells you all about the course. I'm drawing a blank. I was referring to the detailed sheet. I know what you're talking about. You're talking about this
Were you talking about syllabus?
syllabus. That's the word I was looking for, John. Thank you. This this is the syllabus here that I'm showing now. That's the word. I'm getting old, John. I'm getting old. And then I don't know, Philip, if this was what you were talking about, but I don't want to go too into detail on all this. I just wanted to show you. It's just a journal of the trades we do. These are actual trades we place, and we're doing real well with them. So thank you, Lewis and Ken typed it in there. Thank you, guys. I don't know. The days are getting longer. I don't know.
A question from Lewis: how much time to dedicate per week for this course?
That's a good question. So here's how I answer that question. First of all, let me say this. It's not one of those, and I don't mean this as this was the intent of your question. Please don't misinterpret what I'm about to say. But you got to put some time into it, right? So it's not something I'm going to tell you takes 5 minutes a week, and you'll have it all down, in a month, and you won't need any help ever again. You got to put some time. So the way I look at it right now is this: each of these modules are about an hour long, give or take. The mastery sessions last about an hour, usually a little more. John and I stay on the mastery sessions as long as there are questions. I don't put a time frame on it. It usually takes about an hour, hour and 15 minutes. So there's in 1 week you have an hour of watching the module and about an hour of a mastery session. So throw another hour in of practicing doing the homework and going into VectorVest and trying to replicate the concepts, so that you can break it down that way and do the math. Here's the key though: once you've got it down, once these modules you've gone through and understand how to build these investment plans, then it becomes much easier. Then I would say, here's a process where you don't have to spend hours a day. I just don't ever want to sound like that guy who says, hey, 30 seconds a day and you'll triple your money in 6 months. That, I would never do that. It takes effort and it takes some time. But once you've got the plan down, once you've created the process and you understand it, that time it doesn't take a lot of time to actually implement it. So that's just one point I want to be clear on. John, I see Theodore's question there. I'm gonna answer real quick. He said, "How much time is involved in managing the options part of managing the retirement portfolio? 5, 10, 15 hours a week?" No, Theodore, not even close. Not even close. The great thing is with our option trades. Again, I don't even like to. We're not really trading options. We're doing a covered call trade, and then when the time tells us we should be, we're doing a protective put option. So I hate to even say trading options, but I'm bringing up a quick account here to. What did I just do? I just want to show you something really quickly here. Sorry, I didn't have this open already. I should have had it open already. So when it comes to and I'm talking about the buy right here, real quick. I can get this up here. I just want to show you one thing. So here's the current AMD trade that we have open. Okay. was it last week? Not even 2 weeks ago. We bought 200 shares of AMD, just like I showed you on that other one. This is an actual trade that's open, and we're short 200. I'm sorry, short two calls. So we're up $831 on that particular trade. Lennar was a home builder we did this past Tuesday. Now, here's the point about time, and the reason I want to bring this up. So we have a system that says, okay, we place our trade, but we also walk through. Sorry, we also walk through our risk management techniques. So my system has a profit target and a loss target, right? And so let's use AMD as the example. AMD right here. So I have a stop, right? I have a stop order into the downside and a limit order for my profit. So I don't have to sit and stare at this all day long. Pop it up once or twice a day if you want, as long, as much as you want. Maybe you have the app on the phone or whatever it might be. But you don't have to sit and look at this all day. Same thing with Lennar. We have our stop price, we have our other price, all set for you. Right? We have examples here in another portfolio. We have covered calls against stocks that we already own. So here's one at a time when the market was looking a little toppy, and I said, let's go out and generate some income on Logitech. We own the stock at 75. I took in 215, sold the 90 strike. I'm going to make 200 bucks. Next Monday, I'll sell another one from it, make another couple of $100. Okay. So all of these end up working out pretty nicely. That's what we do on our Tuesday sessions. Luis, you can sign up by going to www. Here, let me do this. www.vectorvest.com/URS, and as John showed, or he typed it in the box, you can actually click there, and you can sign up right now and take advantage of saving that money. And John just typed it in there for you as well. Philip, I'm still not sure which slide you're referring to. It was a vertical rather than horizontal pictorial portrait. John, can you type that one in for Dan? Well, I'm pretty sure that's what it is. Whoops.
I got it.
John, okay, thanks. Yep. Okay. All right, I'm just kind of scouring through here. I know John answered a lot of these. We answered a lot of them. Still, folks in the room, I'm happy to answer any other questions that you might have. If anyone else is signed in, let us know you're in. Always good to see. I'm just trying to kill a few minutes to make sure everyone who's still in the room gets their question answered. So I'm in no rush to pull the plug on our session here. I'm happy to stay. Okay. All right. So, we have these trades open. You guys get to come for 6 weeks to the coaching group that will do these trades. All three of these are profitable already. You pay for the course pretty quick just in those 6 sessions. Sue-Ann, you will get a replay of this session. Will come out to you. Um, a replay of the session. It actually it may be one of the sessions we did on Thursday, so maybe it'll be the same presentation though. Is going to come out to you probably later this evening. Back at you, Sue-Ann. At least you said the sign up kicked you out. Okay. Luis, are you a current subscriber with us? Okay, so you should be able to get in there if you just go in. That's not the one I want. If I click here. So, Luis, when I go in, I hit purchase course now. Let's go there. And when you hit proceed to checkout, it should allow you to come right in here. So remember, don't don't type in the information there. Go to because I've already been in this page. It's not bringing me to it. Go to the bottom of the page where it said if you're already a member, hit sign in. It should get you there. Okay. Luis, I'm gonna give it just another minute to make sure you can get in there. Give anyone else a chance to do this. Sanjay says so. No other costs involved to do options. Sanjay, no, there is no other cost. There's no um, hidden software that you need. VectorVest certainly makes it easier, but there's no add-on software that you need to do covered calls or protected puts. Oh, Luis is in. Great. Good job. Oh, and someone, yeah. Philip says, will the discounted price still be available from the Thursday session? I'm not sure I copy that. The $4.95 price, Philip, is good for probably another half hour. If you mean last Thursday session, that's what's offered right now as we speak as well. The $4.95. Theodore says, I'm looking for the most aggressive way to increase my retirement savings. Is this the best course VectorVest offers for that? Theodore, you're going to. No. The short answer is no. Is this an aggressive way to increase your retirement money? It's a roughly worded, tough question to answer worded that way. Are we aggressive? No, not in this course. We have options courses, we have swing trading courses, we have what's called the Derby or the Jockey Club, which is very short-term trading ways to trade. Um, you know, so it's a difficult way to say that. I don't know. I went back earlier from when I was showing the slides on the returns on the growth portfolio was averaging 28% annualized rate of return. I don't know if that's not an aggressive amount to grow your portfolio. Um, I don't know. I put 28% up against the most aggressive active trading systems that I know of. I would get in the ring with any of them. So I'm not. I'm not real sure how to answer your question the way it's worded, Theodore. I mean, I can jokingly say this is by far the best course VectorVest offers. It is a prudent slash conservative way to beat the S&P 500 and grow your retirement. If 28% a year isn't aggressive enough, I would push you towards a swing trading, day trading, should join the Derby. Philip says, what about the market? How can you be certain of the ability to recoup your cost given the uncertainty of the market? Philip, I wasn't by any stretch, and I hope it didn't come off that way, um, guarantee anything, right? So I never guaranteed anything. I've been trading for 30 years now. I've been at VectorVest for 14 years. Um, the one thing I do know is that there's never a guarantee on what the market's going to do. And, that's the beauty of understanding protective puts. You know, we have courses, we have other option courses of buying put options to profit in a downtrending market, um, minimizing your losses in a downtrending market. You know, uh, you know, I said earlier that the core of what I do and what I want to be able to do is to help you preserve your net worth first and foremost, and then grow it. Preserve it first, and then grow it. So, Theodore, if that maybe that answers your question on aggressiveness. 28% per year. If somebody doesn't think that's a fairly, I wouldn't say aggressive way to do it, but if that's not enough, then you have to reevaluate. You know, you have to reevaluate. Theodore, fantastic. Theodore's in, even with my answer. Fantastic. We'll get you there, Theodore. Keep an eye out for an email. It may go to your spam or junk folder, but it'll come. It'll give you all the directions to get into the university, as I showed earlier, and you'll see all of the resources that are available there. And I do look forward to seeing you on the 23rd on the live session on Monday. All right. All right, folks. John, thank you for helping out in the background. I'm going to stay on for about 30 more seconds. If you have a question about getting into the vectorvest.com/URS to get in, go ahead and type it in now. Remember, you can call our product support folks and they will help you. That $4.95 price, again, will be available for a little while longer. It's not going to shut off in the next 5 minutes, but take advantage of it. I don't know when they have it scheduled to close out, but take advantage of that price. It is risk free, it is money back guarantee to you. Money back guarantee. Okay. All right. So, Daniel, thank you. All right, with that, I'm going to wrap it up, guys. Stay safe, stay healthy. I hope to see you on Monday. Sign up for the course. I think you'll get a lot out of it. If not, like I said, we'll give you your money back. Have a great rest of your week, and we will hopefully see you Monday. Thank you, everyone.